Warren Buffett once said, investing isn't just picking a company or a thing to put your money into, but planning your money's future. One ideal investment for that is JPMorgan's special fund, JEPI. It's made for people who want regular income and less ups and downs compared to the whole market. In this video, I'll show you all about the JEPI ETF, including its investment strategy, how it makes money, and how it manages to pay dividends every month at a 7% annual rate. And in the end, I'll show you how this fund can help John with a $100,000 investment reach a valuation of over $3 million that pays over $400,000 in annual dividends or over $30,000 per month, all while being conservative. But first, let's start with the ETF itself. The JPMorgan Equity Premium Income is a fund that tries to make the ups and downs of investing smoother, along with giving investors monthly income. Simply put, it helps spread out where you get your income. It gives you money regularly without worrying too much about certain risks that other money tools might have. It does this by selling something called options on the S&P 500 index. More on that later. Basically, this helps JEPI give you money every month without the big ups and downs you might see with other investments. So the question is, why JEPI? When people think about investing in a fund like JEPI, they're usually looking for two main things. First, they want income on a regular basis, which matches some people's investment plans. Second, since this fund doesn't move up and down as much as the market and doesn't always follow the market's lead, it can help investors spread their risks and better manage their investment mix. Here's how a fund like JEPI works to achieve those goals. This ETF is split into two parts. The first part, making up about 80% of the pot, is filled with investments in companies. The people actively managing the ETF pick these companies using a special system that looks at how the company is doing, how its stock price might be reacting too strongly to recent news, and how well the mix of companies in the pot can work together to not jump around too much in value compared to the big list of companies known best as the S&P 500 index. This part of the pot has investments in 132 different companies, and no single company's slice is bigger than 2%. JEPI doesn't put as much money into tech companies as the S&P 500 does, but puts more into manufacturing and everyday goods companies. The second part is a bit trickier. It involves something called an equity-linked note, ELN for short, which is a fancy way of making money by betting on where the stock market will go. They do this by using a strategy involving call options, which are basically agreements to sell stocks at a certain price. If the stock market stays below a certain level, JEPI makes extra money from selling these agreements. If the market goes above this level, then the ETF doesn't make more money than the agreed price, but this helps keep things steady and pays out money to investors every month. The call options are like a side deal with banks that the ETF makes and renews from time to time. So what JEPI tries to do is make a steady pot of money by having a solid base of company investments that don't shake up too much, which is the first part. And it has a clever way of making regular income through the stock market bet, the second part. This mix aims to give investors a smooth ride and some cash in their pockets regularly. Remember, in the end, I will show you how the combined approach of this ETF will help John with a $100,000 investment reach a portfolio valuation of over $3 million, paying over $35,608 in monthly dividends. To get a better look into its performance, let's examine JEPI's past performance alongside other ETFs and see how JEPI stands among them. When looking at different funds to add to your investment mix, it's helpful to see how they've done in the past, especially if you want ones that don't jump around too much in value and give you some money regularly. Let's look at three funds besides JEPI to see how they stack up. Global X NASDAQ 100 Covered Call ETF, Nationwide NASDAQ 100 Risk Managed Income ETF, and the Invesco S&P 500 High Dividend Low Volatility ETF. When we check out how well JEPI and these other funds have done since they started, JEPI and SPHD are at the front of the pack in terms of total money made. JEPI made a 56.04% return over a bit more than 3.5 years, which is pretty good, although not as high as the 76.38% the whole S&P 500 made. This makes sense for a couple of reasons. First, because JEPI aims to be steadier and not as bumpy, it might not pick the fastest growing stocks, especially in tech. Second, the way JEPI uses options means it might not make as much money when the stock market is going really strong. But when we look at how shaky or stable the funds are, JEPI does really well. It's less bumpy than the S&P 500 and beats out QYLD, NUSI, and SPHD as well, making it the smoothest ride of the group. You can see in the graphic that JEPI's managers aim to distribute a 6 to 10% return annually based on income alone, with most of that coming from the written call option premiums, plus minus any capital gains or losses from the underlying portfolio. It's pretty standard fare and a good structure overall. And that is working so far for the ETF. Even better, it means JEPI could offer a chance to make a good amount of money regularly, which was really attractive when the interest rates were super low and when other types of investments like government bonds were losing money. The ETF stood out by offering a way to earn money when it was difficult to do so elsewhere. However, just chasing after high earnings can be risky. In the world of investing, there are products that promise big returns of 10 to 15%, but those promises might not always be kept, and the product might not be as good as it sounds. JEPI has been popular partly because it offers these attractive earnings. Another plus for the ETF is that it's actively managed. This means that instead of just following a set index or formula, there are people making decisions on which investments to pick to try and maximize returns. This approach lets the ETF better adjust to what's happening in the market, aiming to keep things steady while also making smart investment choices. And getting all this for a fee of 0.35% is seen as a good deal. Sure, it's not as cheap as the really low-cost big company funds that charge 0.03%. But for an active fund that tries to earn money while keeping things less bumpy, it's considered a reasonable price. Now don't forget, coming up in the end, I will show how this ETF will help John with a $100,000 investment reach a portfolio valuation of over $3 million, paying over $35,608 in monthly dividends. But you also have to be prepared for what could go wrong with JEPI. If you really get what JEPI is all about and how it works, it can be a good part of your investment mix. But if you think it's going to replace everything else in your portfolio or give you big stock market wins plus a super high income, you might end up feeling let down. First off, JEPI is a covered call ETF. These kinds of funds don't usually do as well as the bigger market indexes over a long time frame because there's a limit on how much profit you can make. They do best in a market that's not going up or down too much or is slightly going down. In those situations, you could get a nice income and possibly do better than the big market indexes. But since the market often goes up, these funds usually don't beat the big indexes over time. The income in the form of dividends you get from funds like JEPI can change a lot as well, especially with how up and down the market is. When the market is really bouncy, the income from these funds can be higher because the options they sell can make more money. For example, in 2022, JEPI was giving a really high income because the market was incredibly bouncy. But in 2023, things changed. The market became less bouncy, especially after a couple of big banks had trouble in the spring. Now, the money JEPI gives out is a lot less than at its highest point last year, and it's not that much more than what you could get from super safe government savings options. The situation with people looking for income from their investments has really shifted in the past year, and that affects how good JEPI appears as an option. Which brings us to the big question: is JEPI still a good investment? If so, how much can you get from a $100,000 investment? Let's find out. To determine John's potential earnings from a $100,000 investment, we need to consider factors such as average share price appreciation, current dividend yield, and dividend growth. Since the ETF is relatively new, relying solely on its historical values for long-term investment may not be prudent. Therefore, a conservative approach is necessary. Firstly, let's see the share price appreciation. The ETF is not specifically designed for high price growth, with its management team confirming an average appreciation of 5 to 10%. Since its inception in 2020, the ETF has grown by 14.19%, averaging around 4.52% each year. Taking a conservative estimate, we'll assume 3%. Next, we consider the current dividend yield, which stands at 7.63%. However, this yield has fluctuated, with the highest recorded at 12.85% and averaging around 9%. To be on the conservative side, we will use 5% for future projections. Lastly, we look at dividend growth, which has averaged 12.66% since inception. To remain conservative, we'll use 7% for future projections. Now let's calculate John's potential earnings from a $100,000 initial investment based on these figures. In the first year, John's money is projected to reach $108,000, and he'll get $5,000 in dividends. Not bad, right? But there's more to come. After 10 years, John's money is projected to double to $236,757, paying $15,301 in dividends each year. But the real compounding effect of JEPI starts after 20 years, where John's money will reach $727,591, paying an annual dividend of $67,509 or $5,626 per month. Give it 10 more years, and in 30 years, John's initial investment has the potential to grow to a valuation of $3,249,790, providing $427,299 in dividends every year, which is about $35,608 every month. In 30 years, this ETF has the potential to add $3,149,790 to John's initial investment, which includes $616,589 from the growth of JEPI, while $2,533,202 came from dividends. Now listen, if you're interested in index funds, watch the video on the screen to see your investment return from $100,000 in Fidelity Index Funds.